All right, congrats on the quarter. I want to dig into it. You expanded net interest margin by quite a few basis points. What was the driver of that?
The core driver of the 7 basis point increase in net interest margin, which was really strong, was a couple of things. Number one, we've got a short duration securities portfolio, so that's repricing more quickly than most. So we're getting those cash flows quicker. The other thing is we've had success in driving down deposit costs. And so with rates being stable in the second quarter, we were successful in continuing to kind of wrench down deposit costs a little bit, and that's been helpful to us.
I want to talk to you about your commercial and industrial loan business. A lot of data on your loan business in this earnings report as we're talking about net interest margin. So overall, your commercial industrial loan growth was down 8%, but healthcare is up 10%, services up 2%. What is that? I'm sorry, healthcare down 10%. What does that signal? What does that say about what's going on here?
Yeah, I think the broader message with the loan growth, we have 3 specialty businesses that have their own kind of unique characteristics: energy, healthcare, and commercial real estate. Energy and healthcare have had some headwind over the last 12 months or so, mostly around the macro environment. Either in the case of healthcare, the shape of the yield curve created opportunity for long-term fixed rate non-recourse financing for many of our borrowers, so they went to HUD or other long-term fixed rate financiers. That created a little bit of a headwind. That's an anomaly. That business has grown 5 to 7% very consistently over a long period of time. Obviously, energy is part of what we're known for, given where we're located in Tulsa and in Texas. I think that what's happened there is you've had a lot of consolidation in the industry over the last 12 months, and folks are being very judicious about how they use their capital, given where energy prices are. Those pay downs have really belied really strong C&I loan growth. We've made significant investments in talent and our capabilities there on the C&I side. We've always been good there, but we've been particularly strong on the core C&Is. And I think that really is just representative of the great footprint we're in. It's really been across the board: Dallas, Fort Worth, Houston, San Antonio, Denver, Phoenix. Even our home markets, Tulsa, Oklahoma City, and smaller markets for us like Kansas City have done well. And so we've got really strong teams. We're really focused on it. We're doing really good with data, with sales enablement tools and things like that to really help us be focused in our targeting. But C&I has been a real strength for us, but it's been masked by some of the headwinds with these specialty businesses that are really unique. Those are going to go back to growing again. On the energy side, we're close to the bottom of the pay downs there. I think similarly on the healthcare, we're growing again in commercial real estate. So I think we're gonna really see some exciting loan growth in the second half of the year.
Well, Stacy, you're really leading me to my next question. By the way, we're just showing a really good map. Our team made a great map kind of showing where your branches are. You're kind of focused on Oklahoma and Texas, whether you call that the Midwest or Southwest. It doesn't matter. Oklahoma and Texas area, about 2/3, 3/4 of your branches are there. And then you hit some other states as well. I thought this was pretty interesting. So you saw commercial real estate loan growth. Office was down 21%, but industrial was up 7%. Also, retail was up. So let's go into the retail part. What's going on in retail? Why are you seeing retail loan growth? What does that say about brick and mortar stores? What does that say about the state of the economy? That's one area of growth.
Yeah, the death of retail commercial real estate was greatly exaggerated, wasn't it? I think that we're very careful there. But many years ago, there was concern that because of the Amazon effect, that there would be limited opportunities for retail storefronts. That hasn't proven to be the case, particularly in new developments where you've got strong anchor tenants. Retail can be a positive for us. Given the markets that we're in, there's a lot of immigration and strong growth in rooftops, and so that's creating opportunity for residential real estate growth. That's obviously been a strong area for us. It's performed very, very well over a long period of time, and so we're obviously careful with all commercial real estate. You'll see us have less of that than most regional banks, but where we lean in, we feel very confident. Industrial is another area that we've seen growth in.
Well, Stacy, really quick, I want to interrupt you because that's what I really want to ask you about specifically when it comes to the One Big Beautiful Bill. What are your expectations when it comes to industrial loan growth? Are you already starting to see signs of an increase in CapEx spending and kind of a build out of manufacturing coming back here to the U.S., or at least buildings to support some of the manufacturing that's already based in Mexico?
Too soon, I would say. The industrial growth for us is more kind of the warehouse effect. So, just folks working on their supply chain and working on being able to deliver timely products to their customers. It's a very simple construction. And for us, that's really what we've seen. I think it's too soon to see if there's going to be, any broad re-onshoring of manufacturing activity. Obviously, that would be of great benefit to us. Given our footprint, I think we'd be a strong beneficiary of that. But I would say it's too soon to see obvious signs of that from the big, beautiful bill.